The Federal Reserve is about to make a move that changes everything for your portfolio. According to the data right now, there is an 87% chance of a rate cut when they break silence on December 17th. But while the herd is blindly chasing tech stocks at all-time highs, the smart money is quietly rotating into the one sector that Wall Street left for dead in 2024. I am going to show you 3 healthcare stocks that are rigged to explode the moment Powell speaks. One is a growth monster, one is a deep value play, and one is the steady cash machine you need. You need to be positioned before the announcement. Let's dive in. First, let's look at the battlefield. The Fed's final meeting of 2025 wraps up on December 17th. The market has priced in a cut to the 3.50% range. Now, why does a lower rate ignite healthcare? It's simple math. Biotech and healthcare companies rely on future cash flows profits they will make in 2026, 2027, and 2030. When interest rates are high, that future money is worth less today. But when rates fall, the value of that future cash magically increases overnight. Morgan Stanley's research confirms this. Healthcare historically outperforms the S&P 500 by nearly 15% in the 6 months following a rate cut cycle. We are sitting on a coiled spring, and these are the 3 stocks I'm buying to ride the bounce. Before we get to the stocks, you need to understand the trap that is about to snap shut on cash savers. This is the real rate phenomenon. Right now, you might be sitting in a money market fund earning 4% or 5%. That feels safe. But look at inflation. As inflation cools and the Fed cuts rates, that risk-free 5% yield is going to evaporate to 3% very quickly. Wall Street knows this. That is why trillions of dollars sitting on the sidelines are about to panic rotate. They can't stay in cash, and tech is already expensive. Where does that money go? It goes to sectors with pricing power. Healthcare is one of the only sectors in the economy that can raise prices above inflation, regardless of a recession. When you buy these stocks today, you aren't just buying growth, you are buying insurance against falling interest rates. That is the macro secret the hedge funds are playing right now. Stock number 1 is the king, Eli Lilly. They just became the first pharma company in history to hit a $1 trillion market cap. You might think, is it too late? Absolutely not. Here is why the rate cut is just fuel on the fire. The GLP-1 weight loss revolution is just getting started. In Q3 to 5, Mounjaro and Zepbound alone brought in over $10 billion. But the news you need to pay attention to is this. Lilly just committed over $6 billion to a new manufacturing site in Alabama. Why? Because they are preparing for their ace in the hole, or Forgliprin. This is their daily weight loss pill. No needles, just a pill. FDA approval is expected early next year. With lower interest rates, financing this massive expansion becomes cheaper, boosting their margins even further. Now, I know what the bears are saying. What about competition? What about Novo Nordisk? What about Amgen? Here is the reality check. The barrier to entry in the GLP-1 race isn't just science anymore. It's manufacturing. Making these complex peptide drugs requires massive specialized sterile facilities that take 3 to 4 years to build. Eli Lilly has already spent the billions to build this iron dome around their business. Even if Pfizer or Roche invents a better drug tomorrow, they physically cannot manufacture it at scale until 2028 or 2029. Lilly has the market cornered for the next 3 years. In the stock market, 3 years of monopoly profits is an eternity. That is why the premium valuation is justified. Analysts at Morgan Stanley have slapped a $1,190 price target on it. The stock is priced for perfection, yes. But with the Fed cutting rates, this is the growth anchor for your portfolio. Now, if you like buying $100 bills for $50, look at stock number 2, United Health Group. There is a hidden gem inside United Health that most people ignore. It's called Optum. Think of United Health as 2 companies. One is the insurance company that pays the bills. The other is Optum, a massive tech and services company that collects the bills. Optum is actually growing faster than the insurance side. It includes data analytics, pharmacy benefits, and direct healthcare delivery. By owning both the insurance and the doctors, United Health captures every single dollar you spend in the system. It is a vertical integration machine. So when you buy UNH at these low levels, you are basically getting the Optum technology business at a massive discount. This stock has been a battlefield. It is down nearly 45% from highs. Why? Because of the 2024 hangover, the DOJ probe, the massive cyber attack back in early 24. The market hates uncertainty. But here is the turnaround thesis for 2026. They just reported Q3 earnings and surprise revenue is up 12% to $113 billion. They are finally getting cost under control. They are cutting unprofitable plans and raising premiums by 20 to 30% for 2026. And here is the Buffett signal. Berkshire Hathaway stepped in and bought $1.6 billion worth of shares in August. When Buffett buys a beaten-down giant, you pay attention. With the Fed cutting rates, UNH's massive debt load becomes cheaper to service, directly boosting their bottom line. Risk rating, high. Reward potential, massive. Stock number 3 is my personal favorite for sleep well at night returns, Vertex Pharmaceuticals. They have a monopoly on cystic fibrosis, period. But that's the old story. The new story is why you buy them for the rate cut. Vertex is using their cash pile to conquer kidney disease. Their new drug, povetacicept, just dropped 48-week data showing a massive reduction in proteinuria for kidney patients. I mentioned the kidney drugs, but I saved the best catalyst for last, non-opioid pain management. We all know the opioid crisis is a tragedy. The world is desperate for a painkiller that works without addiction. Vertex has a drug called Suize, VX548. It targets the sodium channels in your nerves to block pain signals, without touching the brain's reward centers. This is a multi-billion-dollar market waiting to be unlocked. If Suize becomes the new standard of care for post-surgery pain, the revenue potential rivals their entire cystic fibrosis business. You are getting this call option on the future of pain management effectively, for free at today's price. This pipeline alone is worth billions. Because Vertex is profitable, $3.3 billion in free cash flow. They don't need the Fed to cut rates to survive. But when rates do drop, the intrinsic value of their long-term pipeline skyrockets in the eyes of Wall Street models. So here is the trade. If you want growth, you buy Lilly. If you want a turnaround, you buy United Health. If you want quality, you buy Vertex. The Fed announces on December 17th. The rotation into healthcare has already started, but the floodgates haven't opened yet. The question is, will you be positioned before the rally, or will you be chasing the green candles after? I want to know which of these three is going into your portfolio. Are you Team Lilly or Team Buffett? Let me know in the comments below. Finally, a quick but important reminder. I am a financial analyst, but I am not your financial advisor. The stocks mentioned Eli Lilly, United Health, and Vertex carry risks, including regulatory changes and clinical trial failures. The content in this video is for informational and educational purposes only, and should not be construed as personalized financial advice. Always do your own due diligence and consult with a certified professional before making any investment decisions. If this analysis helped you, smash that like button. It really helps the channel, and subscribe so you don't miss the next alert. See you in the next one.